Welcome to this explainer. You know, when we talk about the AI data cycle, we usually think of flashy chip makers. But today, we are tearing down the financial transformation of a company that has quietly become the absolute unsung hero here, Western Digital. If you're an institutional investor looking for bulletproof balance sheets paired with seriously aggressive share repurchases, well, the data we're about to look at is just fascinating. Let's dive right in.
Plus 981%. Yeah, you heard that right. This once, frankly, kind of boring hardware stock has nearly returned 1,000% in recent years, literally tripling its value in the first half of 2026 alone. Now, for a legacy tech company, that kind of wild price action usually signals one of two things: a massive structural shift or a massive bubble.
Which brings us to the core question of today's explainer. Why on earth is Western Digital CFO, Chris Sandisk, out there telling Wall Street that this storage boom is just getting started? I mean, despite the massive run-up we just talked about, we're going to look at some hard data today suggesting that structural changes in AI data demand might actually mean we are only in the early innings of this supercycle.
Here is our roadmap for today. We'll be covering the AI storage supercycle, fixing the balance sheet, the capital return engine, valuation versus peers, and finally, the ultimate execution test. Starting with Section 1, the AI storage supercycle. To really understand this fundamental shift, we have to look at how data is actually being generated and stored for agentic AI right now. Cloud is now making up a staggering 89% of Western Digital's Q3 revenue mix. Meanwhile, consumer is down to just 6% and client is sitting at 5%. So, what does this tell us? This is not your legacy consumer hard drive company anymore. Not even close. Western Digital is now a pure-play, enterprise-driven hyperscaler partner. They are literally supplying the critical infrastructure that powers the massive data centers running AI around the globe.
And the macro catalysts driving that 89% cloud dominance? They are incredibly robust. Management is currently modeling a 25% plus compound annual growth rate in exabyte demand over the next 3 to 5 years. Why? Well, because the shift to agentic AI and large-scale inferencing requires continuous, massive data generation. But honestly, here is the absolute critical metric. They hit record 50.5% gross margins in Q3. They managed to pull this off by increasing their pricing power while simultaneously dropping their cost per exabyte by 10% year over year. And as we know, rising prices plus dropping costs equals massive operating leverage.
Moving on to Section 2, fixing the balance sheet.
Because look, all that operating leverage we just talked about doesn't really matter if you're weighed down by a ton of legacy debt. But the recent history here outlines one of the most rapid and honestly strategic deleveraging stories in the entire tech sector. Let's walk through it. In February 2025, they completed the spinoff of their flash business, Sandisk. Then in June 2025, they executed a really brilliant debt for equity exchange using the retained Sandisk shares. Fast forward to Q3 of fiscal 2026, and they monetized even more of those Sandisk shares to execute a massive $3.1 billion debt paydown. And you know what? The market noticed. By April 2026, Fitch upgraded them to BBB-investment grade. Basically, management fundamentally de-risked the entire company in just over a year.
$450 million. That is Western Digital's net positive cash position at the end of Q3 2026. They wiped out that restrictive debt load we just looked at, and now they sit on a true fortress balance sheet with over $2 billion in cash equivalents. For institutional capital looking for safety right now, this is a massive green light.
Which leads us nicely into Section 3, the capital return engine.
With that balance sheet totally secure, the free cash flow naturally follows. I mean, when a company prints a 50% gross margin, the cash generation is just massive. Just listen to this quote from CFO Chris Sandisk at a recent investor conference. The free cash flow margin is approaching 30%. There is no hesitation. We're buying back almost every day. That right there, that is the sound of absolute confidence. They aren't just hoarding this cash, they're actively deploying it directly to benefit shareholders.
And to really put their money where their mouth is, the board recently authorized a staggering $4.0 billion share repurchase program. That is a massive, massive injection of buying pressure on the open market. And they're executing this efficiently too, perfectly balancing their capital allocation between business reinvestment and aggressive returns to shareholders.
The hard execution metrics for Q3 alone are pretty wild. They executed $752 million in share repurchases in a single quarter. On top of that, they gave investors a 20% quarterly dividend bump, raising it to 15 cents per share. Since launching this capital return program back in fiscal 2025, they've already returned $2.2 billion to shareholders. So this isn't just some vague promise of future yield. It's an active, aggressive shareholder yield engine that is running full steam right now.
Section 4. Valuation versus peers.
So with explosive growth, a fortress balance sheet, and massive buybacks happening almost every day, you've got to wonder, is the stock just too expensive? Well, when comparing Western Digital to its primary competitor, Seagate, a really clear valuation disconnect emerges. On a next 12 months enterprise value to revenues basis, Western Digital trades at 11.71 times, while Seagate is way up at 13.87 times. And looking at EV to EBITDA, Western Digital is at 24.32 times, which is noticeably cheaper than Seagate's 29.68 times. So despite that massive run-up we talked about at the start, Western Digital is actually still trading at a distinct discount to its closest rival.
And what's crazy is this discount exists even though Western Digital boasts a 36.4% forward revenue compound annual growth rate. So what's going on here? Well, the data suggests that Wall Street might actually still be underestimating Western Digital's margin durability. It seems the market is pricing in a return to historical cyclicality, the usual boom and bust, while Western Digital is out there proving they have fundamentally structurally higher margins and superior growth estimates.
Finally, Section 5, the ultimate execution test. Now, as objective analysts, we always have to look at the risks, right? And this is the ultimate risk-reward scenario framing the stock right now. On the bullish side, Western Digital absolutely must flawlessly execute their upcoming 40-terabyte drive volume ramp in the second half of the year. If the hyperscalers absorb these ultra-high-capacity drives as expected, those margins are going to expand even further. But on the bearish side, we have the ever-present threat of historical hyperscaler CapEx slowdowns. If the major tech giants suddenly decide to cut back their infrastructure budgets, well, Western Digital's pricing power could evaporate pretty quickly, heavily squeezing those beautiful 50% gross margins.
Which leaves us with this final, truly provocative question to think about. Is this a permanent structural shift in AI storage demand driven by the sheer data weight of agentic AI? Or are we simply staring at the peak of just another hardware market cycle? Look, the balance sheet is bulletproof, the buybacks are aggressive, and the valuation certainly leaves a margin of safety compared to peers. But the ultimate answer will lie in whether the world's thirst for data truly is unquenchable. We highly encourage you to dig into the filings yourself, weigh the evidence we've structured here today, and decide. Thanks so much for joining us for this explainer, and we will catch you next time.